Welcome, everybody. Thank you so much for coming to Republic's Startup Investing Masterclass. I am here today to walk you through this presentation. My name is Heather Buffo. I am the Venture Growth and Partnerships Lead at Republic. So I work with Cheryl Campos and Zara Nakvi on our venture programs, as well as other initiatives to work with amazing investors like you to invest and find companies to raise with Republic. Today we are talking about terms, and we have two amazing guest speakers with us, Alexandra Lundin from Insight Partners and Mercedes Bent from Lightspeed. So we'll do a presentation for about 20-30 minutes, and then I will invite our guest speakers up onto the stage. Again, thank you so much for coming. This presentation, again, is about terms. You may be familiar with seeing Zara on these presentations. Zara is graduating from Columbia University today, and she's in the middle of her graduation proceedings. So we are wishing her the best of luck and enjoyment with her family and friends. And in the meantime, we're here to talk about terms. As I go through this presentation, if you have questions, you'll notice at the bottom of the Zoom that there is a chat, and there's also a Q&A box. Please put your questions in the Q&A. It's much easier to answer them there. Things kind of get lost in the chat. But feel free to enter them in the chat as well. Q&A is just a little bit easier. If this is your first exposure to terms and term sheets, that's okay. I will say that this topic is very challenging, and there are a lot of terms, obviously, that are somewhat intuitive in the way that they're named, but not really self-explanatory, which is why we're going to go through them. I highly recommend this book, Venture Deals. Whoops, my background is blurring it out. Oh gosh, you can't see it. Oh, I'll hold in front of me. Venture Deals by Brad Feld and Jason Mendelsohn. It is written more like a manual than a book, so I wouldn't recommend reading it cover to cover, but I use this as a reference for anything that comes up in a term sheet that I either forget or don't understand. So I recommend having this on your bookshelf. This was originally published about 10 years ago. It's now in the 4th edition, but really recommend it. Okay, so let's get started. Cheryl's doing slides for me, so I'm going to say next slide as we move through this. So Cheryl, may you please move to the first slide. The book is called Venture Deals by Brad Feld and Jason Mendelsohn. Okay, so we are talking today about term sheets. What is a term sheet? A term sheet is a written document that includes the important terms and conditions of a deal. It summarizes the key points and the agreements by both the investor and the founders. So the Y Combinator term sheet is the one that we are going to be working off of today. As you know, at Republic, we have the CrowdSafe, which is modeled after the Y Combinator safe. I'll talk about safes in a moment, but Y Combinator has some excellent resources on term sheets and securities. So I'm sending in the chat right now a link to their Series A term sheet. So we're going to go through examples based on this. There are lots of different types of term sheets. Most firms have their own version. But again, we're just going to go through the most important kind of top level factors that go into term sheets. Next slide, please. Okay, so what's a term sheet? It is a written document that serves as a template for legal teams to draft a definitive agreement between investors and a company. This document is non-binding. It's legally non-binding. So most firms will view a term sheet as binding in order to maintain their reputation and to avoid conflicts of interest. However, legally it is non-binding. Again, it includes the really key and broad points between ownership terms of both that are beholden to the founders and to the investors. Next slide, please. Okay, key definitions in a term sheet. So when you start the term sheet, of course, it'll have the company in it and their incorporation. Many companies are incorporated in the state of Delaware because of their very helpful tax incentives to companies. So when people say they're a Delaware C Corp or LLC, that's what they're referring to. The first thing that is important to know about a term sheet is the type of security. So this is the name of the round that you're raising. The security of the investment is also known as a convertible instrument. So this could mean equity, a safe, a convertible note, or preferred equity. The term sheet details numerous terms and conditions of an investment. Just one of those is the instrument. Venture investments are typically issued in preferred shares. So today we will continue assuming that we are negotiating a preferred shares term sheet. Preferred shares are by definition more senior than regular equity. This means that preferred shares have more claim to a company's assets than regular shareholders. In the event of liquidation, this can be really important. So for example, if the company doesn't work out and it fails, preferred stock owners get their money back first before common stock. I'm also going to send you this link to another Y Combinator resource that is helpful when looking at different types of security instruments, such as a safe. Next, we have the investment amount. So when you are investing in a company, obviously you need to know how much money you're putting into it. That one's pretty straightforward. It'll also indicate whether the investor is the lead or the non-lead in the investment deal. And then finally, the valuation. We talked a lot about valuation a couple of weeks ago, so I won't spend too much time on it, but just to review, the company's valuation, along with the amount of money invested, determines the percentage of the company that new investors will own. This is one of the most crucial components of the term sheet because it has the most direct impact on who owns what and how much cash each shareholder receives when the company sells. Valuation is expressed in terms of pre-money and post-money values. The pre-money valuation is the company's valuation before the new investment. The post-money valuation, you guessed it, is the pre-money valuation plus the amount of the new investment. So the founder's basic objective is to maximize the amount of capital investment while minimizing dilution. So for example, let's say that a startup is looking for a $1 million investment and their company at that time is worth $5 million. $5 million refers to the pre-money valuation. So the post-money valuation is 5 million plus the 1 million investment, and therefore is $6 million. Most startups, when they are getting these additional investments, will dilute their company about 10 to 30% each round. Next slide, please. Liquidation preference. So the liquidation preference sets out who gets paid first and how much they get in the event of a liquidation, a bankruptcy, or a sale. Liquidation meaning you get your money back or you get any type of money. By including liquidation preferences, venture firms try to protect their investments from downside risks by making sure that they get their investment back before any other shareholders, which they do as preferred shareholders. So downside meaning you don't want to lose your investment or be negatively affected by giving away your money. So liquidation preferences in most term sheets today are typically 1x non-participating preference. What does that mean? Two things, 1x and non-participating. So starting with the 1x. 1x means that if I put $1 million into a company, I will get $1 million back first. Which is just the money that I invested. In the event of a bankruptcy, for example, before any of the money goes to common stock shareholders. The no participation part of that phrase refers to, this means that the stock does not participate after receiving their liquidation preference, meaning they get their liquidation preference and nothing else. So in a 1x non-participating preference, if something happens, you just get your principal investment amount back. In a fully participation preferred stock, on the other hand, the investor gets their liquidation preference plus a portion of the remaining assets on an as converted basis. And I will talk more about that in a second. Dividends, this is not too important. It's included here because it often shows up in term sheets, but most venture capital investors are not investing for dividends, which means payments that are made out on a regular basis over time. Instead, they are looking for investments where they're going to get a large return at a later date. So again, an illiquid investment. So they're going to put some money in, they're not going to be able to access it until they get a return after some conversion event. So dividends are here. They're not too important. I wouldn't worry too much about them. But they are one way that you can include types of returns to investors. Next slide, please. Conversion to common stock. Conversion transforms preferred stock into common stock, usually on a one-to-one basis. What does that mean? So convertible preferred stock can be converted to common shares at the conversion ratio. The conversion ratio is set by the company before the preferred stock is issued. So for example, one preferred stock may be converted into 2 or 3 or 4 common shares. If the common shares rise in value, the preferred shareholder may opt to convert their shares into common stock, thus realizing an immediate profit versus, again, a much later return. The price at which converting becomes profitable for the investor is called the conversion price. So there are two types of conversion rights, and this is the important part for the terms. There's optional conversion and mandatory conversion. These definitions are pretty much how they sound. So optional conversion rights give the holder the ability to convert her shares of preferred stock into shares of common stock. It gives them the option. I literally can't explain this anymore. Mandatory conversion, it obliges the holder to convert their shares into shares of common stock at a predefined event, such as an IPO. So this happens, again, automatically. So sometimes you'll hear this referred to as automatic conversion. The next term that is important for investors to think about are voting rights. So this generally refers to the right granted to preferred shareholders to participate in voting alongside common shareholders. This is an important power, as the ability to vote on corporate affairs is often a primary characteristic separating preferred and common shareholders. This can alter the state law default rule, which each class shareholder approves any major action, such as amendment to the Articles of Incorporation. So to give you a very dramatic and extreme example, let's say I invest in a climate company or a company that has a commitment to climate, and they vow to be carbon neutral and reduce their or minimize their plastic use. Then maybe 2 years from now, they decide, you know what, plastic is really cheap. It is going to benefit my investors to increase my profit margins by using plastic products. And so I'm going to take this company in a new direction. If you don't have voting rights, then you don't have the ability to veto that or express your concern about that, which may be important for the reason as to why you invest in that company. If you do have voting rights, you may be able to give an input on that. So voting rights can be really critical depending on what you're doing. So these elements of conversion and voting rights are really critical. So if you have invested on Republic before, you'll note that in the crowd safe, both of these terms are included. For conversion, again, the crowd safe usually converts at a predetermined point determined by the company and Republic when they enter into an agreement to raise with Republic, and it usually happens at the exit. So once you invest in a company on Republic, your investment will be converted into stock or into whatever the agreement says at the time of an acquisition or an IPO. Republic investors also do not get information or voting rights when they invest on Republic. This is a key feature of the crowd safe, which allows companies to represent Republic as one line item on their cap table. If you have 1,000 investors, you practically speaking cannot take 1,000 votes on every given matter that the company engages in. So it's something to consider as you think about your investments, but is a key feature of the crowd safe. Thank you. Next slide. Great. Board of directors. So the board of directors oversees the strategic planning for a company. It appoints the officers of a company. So the CEO, the CTO, the C, insert letter O. They approve the budget and they generally set the direction of the company's activities. In the early stages of a company, your board should be made up of people who will add value to your efforts to launch and grow your company. And you should think critically about what each member brings to the table and how they will work together. So often in early stage companies, there's about 5 people on your board of directors. There's 2 people representing the investors, 2 people representing the company, often the founder or founders, and 1 person who's independent. This arrangement ensures that everyone's voice is heard and that there's a neutral third party present to resolve any disputes as they arise. The next term is founder vesting. So vesting is a legal term that means to give or earn a right to present or future payment, asset, or benefit. It's a type of incentive structure which says you need to work for a company for a certain period of time if you want to become an owner. So for founders, this typically is inherent. However, a departure by a founder from a company can be extremely painful. you lose institutional knowledge, you lose the vision, you lose the leader of the company. So founder vesting seeks to increase their commitment to the company so that they stay as long as possible. This point cannot be overemphasized enough. A founder will hardly ever leave in a lighthearted fashion because of their intrinsic motivation to move the company forward. So it will likely have a negative impact on the company and their shares. But if they're in a tough position for whatever reason, then vesting may be something that affects their decision. So the shares returned to the company upon a founder exiting allow the company to retain and incentivize a replacement without massive dilution of the shareholders. So it's important that the vesting schedule make that possible. I'm going to send now in the chat another link. Carta has a lot of really great resources on vesting and vesting schedules. So highly recommend that. I do see, just since I'm here, a question that's asking about the CrowdSafe. I can come back to that, but the CrowdSafe is a security instrument that Republic uses for investors to invest in companies. Oh, shucks. I have been sending my links just to the panelists. Here we go. Okay, there you go. Thank you. Apologies. I will resend all of those links at the end. Cheryl, could you go back one more slide real quick? I'm not finished with this. Okay, thank you. As we're talking about founder vesting, if there are 2 or more founders, the founding team often recognizes that there should be no free lunch, which basically means that if someone changes their mind later on, then the vesting schedule should be set up before any investors come on board. So vesting schemes typically foresee a vesting period of 36 to 48 months, starting just at or before the investment. And the shares subject to vesting, it's called investing shares, gradually become vested during this period. So they're fully owned by the founder without risk of them losing them in the case of a departure. Vesting usually happens on a monthly or quarterly or sometimes annual basis. A lot of people prefer the more frequent, the better, to align incentives. And sometimes it includes a cliff, which means that the initial vesting period is longer than the rest of the vesting period. So for example, after 1 year, your vesting actually begins. And after that, each quarter, you're entitled to another 25% of your shares. Next slide, please. Okay, the no-shop agreement. The no-shop agreement in a term sheet is a confidentiality agreement prohibiting founders from using the term sheet to solicit offers from other potential investors, including the no-shop agreement. Means that investors don't want you to use the terms of their deal to gain leverage with another firm. So when you're looking for a job, sometimes you might use offers for salary to leverage a better salary from another company from a better job that you want. In venture investing, this is a no-no because it really ends up creating a dynamic between the investor and the founder that might not indicate that there's trust, which again is really important. So the no-shop obligation requires that the company and the founders do not solicit any offer of an investment in the company by a party other than the venture capital investor for a certain period. So typically, investors are conducting due diligence in parallel with the time that they are negotiating a term sheet with a founder. So again, because these are kind of simultaneous processes, while the investor is making sure that their investment decision is sound and that the company is in a position to be invested in, the founder is also looking at the terms of the term sheet and making sure that the money that they're going to take on is going to align with their interests. So while they're in this mutual kind of relationship period of determining whether they're the right fit for each other, investors ask that founders do not look around to other investors. This can be a really touchy sticking point for investors and founders, so it's best that you just be really open with your investor and understand what you're getting into if you include a no-shop agreement. This also applies, if you go back for 1 second, Cheryl, this also applies in the case of being solicited any offer for an acquisition of the company or lease of the company. So even if someone comes to you separately and says, we want to buy your company, if you have a no-shop agreement while you are negotiating a term sheet with an investor, the that no shop agreement will mean that it is you cannot get into possible acquisition until that term sheet is finalized. So in other words, the company is required to work in good faith expeditiously towards a closing of the venture capital transaction. So as fast as possible, close the deal. Okay, great. So a couple of just final pointers for companies and startups and founders while you are in the term sheet negotiation process. And again, these term sheets are really long. They can be dozens of pages long. There are tons of things to consider. However, there are just a couple of things that are really important to remember. So one thing as a caution for founders is a lot of people think that my best strategy is just to raise as much money as possible. And therefore, if I have more money, I'll have more options. I can do more marketing, more sales, what have you. However, the more because of the terms in these investments, the preference stack and the liquidation preferences, getting more money does not necessarily benefit you because it will dilute your shares and it has all these strings attached. So a lot of people talk about raising smart money and only accepting investments that are the perfect fit for you and your company. There's kind of a spectrum of points of view on this, on whether smart money is important or whether really money is money and so it doesn't matter as much. I really think that it is important, as you have an investor in your company, you are obligated to that investor because they are giving you money to move your mission forward. So it is really critical to think about where your money's coming from and what terms are tied to that. And then finally, another thing to look out for is downside protection. So the term downside protection, I know I've thrown it around a little bit, but basically downside protection is where investor says, okay, I'm giving away a bunch of money in my life as an investor. The majority of my investments are going to fail. And so I want to protect myself from losing money as much as possible. That's what downside protection is. And it's really protecting your principal investment. So if an investor is solely focused or mostly focused on their downside protection, so protecting their principal investment, it might indicate that they are not so focused on the startup and their success and the ultimate upside. Maybe they're just trying to diversify their portfolio. They're willing to take a bet, but they don't have a ton of faith in it actually executing to the return that they're looking for. So as you're negotiating terms, just look out for a couple of those things. Okay, so that was a lot of information. Hopefully it was understandable. I'm now going to introduce our lovely speakers and give you a quick introduction to them. Again, keep your questions coming in the Q&A box. Cheryl's fielding those while I'm talking. Oh, and while I'm here, I will send you resend the links that I failed to send to everybody at the beginning. And then I'll introduce our speakers. So this is our Y Combinator term sheet, and these are the securities. Okay. Those are all my helpful links. Great. Okay. So today I would like to welcome Alexandra Lundin and Mercedes Bent. Alexandra Lundin joined Insight Partners in 2017. Previously, she worked for Future Perfect Ventures, an early stage fund focused on fintech and distributed ledger technology. She was also part of the virtual reality team at Global Nomads Group. Alexandra graduated with honors from New York University with a Bachelor in Science in Finance from the Stern School of Business and a Bachelor of Arts in Computer Science from the Courant Institute of Mathematical Sciences. During her time at NYU, she conducted research on the evolving economics of on-demand transportation and the adoption of autonomous vehicles in partnership with Uber and BlaBlaCar. Mercedes, who will be joining us hopefully in just a few minutes, but just to give you her bio as well. Mercedes' path to venture capital has been a true convergence of her life experiences. A childhood surrounded by investors, studies at Harvard and Stanford, and finance roles at the Federal Reserve and Goldman, and managing P&L at startups in VR and ed tech. Her long-term goal of empowering communities she cares about has really informed her work. She began her venture capital career at Owl Ventures before joining Lightspeed's consumer investing team in 2019. So please join me in welcoming Alexandra and Mercedes when she gets here to the stage. And I am going to do the host things and change my participants to get them on stage. Okay, Alexandra, there you are, yay.
Hey.
Hi, how are you doing?
Doing great. It's good to be here.
Thank you so much for being with us. As soon as Mercedes gets here, we will join her. We'll have her join us on the stage as well. But thank you so much for being here. We're really excited to have you. So you have been in venture capital for a while now. And a lot of investors, I think, on this call are curious before diving into venture capital investing. About best practices for a career in VC. So what do you think are some steps that people can take to help lead to a really successful career in VC and startups?
Yeah, I think the biggest thing is real curiosity. Like I think one of the things you really can't make up in this world is genuine interest in the job. So curiosity about the companies you're evaluating and like enthusiasm for what these founders are building, and then taking a step back and like understanding the real world and market level implications that they have. And so I think figuring out areas that are exciting to you personally is the first step. Cutting edge technology is a consumer product that you can use and experience yourself for like life biotech. Um, but it's challenging. Like you have to be excited, you have to stay excited. And so that means that you really have to have the hunger to continue to educate yourself and to push yourself to think about, think beyond what's really in front of you. And so it's just always learning. It's really enthusiasm for that I think is the most important thing.
I totally agree. Could not agree more. Alexandra, I think your audio is a little bit choppy. I'm not sure if there's anything you can do about that. But while Alexandra's working that, I'm also going to bring Mercedes on the stage now. 1 second. Okay, Mercedes, do we have you here? Hooray. Hi, Mercedes.
Hello. Good to see you.
Thank you so much for being here. So I was just asking Alexandra about what are some amazing steps, or, for those of us who are new to investing or interested in getting into VC and startups, what are some things that you think contribute to a successful career in VC and in startups?
In terms of how to get into VC, you're asking, in terms of if you're interested in that career path?
Maybe not getting into VC, but, once you are, like, what are some things that really contribute to success?
I think in VC, there's really 4 things that we do. We source deals, we win deals, we evaluate deals, we win them, and then we serve as the portfolio company board member. And so I think about a lot of success in VC as being, how do you make sure that you're really good at all of those stages? Someone yesterday told me a good one. There's a 5th stage, which is that, you have to actually exit the company, which is very true because you have to actually make money on it. And so I think, some of the keys to success there, VC is really a sales job. You're selling money, but you're also selling really trust and psychological safety in some regards with the founder around, you're someone that they can confide in, you're someone who will be a good coach, you're someone that they should get on their journey for working together for the next 7, 10, 15 years. Not sure how long the relationship might be. But when I think about that, I think about, okay, everything you need to be good at from a sales perspective of reading the room, understanding which deals are hotter in play, what you need to push on in order to kind of get something across the line, as well as being a really empathetic coach. It's not like you're the CEO, you're not the one driving the strategy, you're not the one saying this is what's going to happen. You have to be the person kind of who's able to spot the insights that the founder has and help shape them and make sure that they come out of the founder. And sometimes the founders don't even realize that they have the answer. Mm-hmm. So I think those are kind of some of the really high level keys to success, I think, in VC.
Mercedes, those are really great points. And I think that part about relationship development and ongoing relationship maintenance are really important. And it sounds like you've come to a lot of really excellent insights and conclusions based on your experience. So can you think of any particular moments or experiences in your journey as an investor that have shaped who you are now as an investor and a professional?
I was an operator. So I spent about half of my career, the last 12 years or so, I spent half of it as an operator and half in finance. And I think that the, perspective of an operator really, really shaped my perspective on how to be a board member. And in some ways, my very first board meeting, I remember being so nervous, like, oh, what am I going to say? Am I going to have anything useful to provide insight on? And I really realized that, I started my own company. I worked at a venture-backed seed stage company. I also worked at a Series A through Series D venture-backed company. And so I've kind of seen a lot of stages of growth from an operator lens. And a lot of that just came back really naturally in terms of thinking about organizational structure, people issue, KPIs, how to, scale the company. Like a lot of the just scaling and growing pains are pretty common regardless of what type of product you're focused on. So I found all of that was really helpful in helping me prepare, for the VC role.
Excellent. What about you, Alexandra? Are there any moments that really stand out to you that have shaped you as an investor?
Hopefully my audio is better right now, but tell me if it's not. Okay. I mean, I think it's hard to distill into moments. I think it's kind of been an ongoing journey and it's always changing. I had a pretty non-traditional route into the world, and it was kind of almost by accident that I fell into VC. I had kind of a lot of trial and error and finding what was interesting to me. So kind of a lot of my friends did the typical business school, traditional route through banking internships, whereas my first internship was actually a recruiting role for a tech company. And so through that, I was exposed to all these cool companies and innovation that was going on. And that led me to Feature Perfect, which was this early stage fund that I was starting to do a bunch of research for. And that kind of entrenched me into this startup world. And then I spent time with a startup actually working on the operational side, working with this tech that I was excited about, and before coming to Insight. And so I've kind of seen the world from all these angles, and those angles all directed me here. And so I think what started, or since starting at Insight, which was my first real investor role, the biggest thing for me was learning what it means to be an investor. And it kind of sounds silly, but Insight is this group of really successful, awesome, smart people. And it was intimidating at first. And I think I had this view of the right kind of personality or type of person that would be successful in this world. And some of those things didn't really come naturally to me. And so it took me some time, and I'd say even until maybe 12 months ago, to really say, okay, these are the things that I'm good at, and these are the things that really interest me. And that's what's going to define me as, or define the kind of investor that I want to be going forward. And so I think just in VC in general, it's really a choose your own journey career, and success can look like a lot of things.
Amazing. I have one more question for you both about being investors before we talk about terms. Do you think that it is necessary to be an operator before you become a good investor? And Mercedes, I'll ask you first.
I don't think it's necessary, but I think it helps a lot. There's certainly, I think about this a lot because there's people who, I came out of school into finance and then I went to operating afterward. There's people who stayed in finance the whole time ever since. And I would say they were certainly ahead of where I was in venture when I first joined, but I very quickly caught up in terms of the ability to kind of talk about your operation, to really share your operational expertise with founders goes a really long way with founders in terms of how much they want to work with you and how much they feel you're valuable additive to the team. So it's not necessary. There's a lot of ways to learn how to evaluate a business. But when we talk about like those 4 things that, investors do on sourcing deals, I think people can build their network any type of way they want. Investors have a great ability, who only had a financial background can do it. But with my operations, I have all these people from my startups I've worked at who always send me deals. On evaluating, probably the person who's been in finance for longer might be better at evaluating the quantitative elements, but there's also a lot of qualitative as well. And so I think that there's a difference there. And then I think on winning deals, honestly, people who have an operator background have a little bit of a leg up on winning deals. And portfolio, being a board member, that one I'm 50-50 on, because people who've been in VC much longer have just seen a lot more board meetings. And so they have a better sense of what, can be an effective board meeting. But at the same time, the operators can kind of rely on that experience. So it depends. If you ask me for which parts, there's positive and negatives.
Awesome. Alexandra, what do you think? Do you have to be an operator to be a good investor?
I think I totally agree with that perspective, Mercedes. I think, especially at the earlier stage, like I think overall being an operator, it gives you a lot more empathy for like the journey of a founder. But I think it does matter what stage you're talking about in terms of like the level of importance. So Insight is more of a like later growth stage firm, but we do earlier stage deals, and a lot of the deals I work on are on the earlier stage. And you can tell that there is a much greater emphasis on like, do you understand what I'm going through? Like, how can you contribute like one-on-one in terms of experiences and just sharing, like, how can I go through this problem and get to this level in the next coming years. And so it's important, but then again, I think once you get to the later stage, like it just becomes a lot more of a more kind of traditional finance like view of the businesses you're evaluating, and it's just a little bit different. But I think one thing that I would do if I could take 2 years off and do anything, I would go into an operating role, because I do think that it would be so valuable to have just going forward.
Awesome. Okay, great. Well, thank you so much for that insight from your wonderful careers. That's really, really helpful. Let's talk about terms now. So can you tell us, at your firm or in your position, what does it look like when you're negotiating terms? Just give us a little bit of insight into that. Alexandra, let's start with you.
Yeah, so for us, negotiating terms, it's often like a combination of back and forth with the CEO, and then our legal team going back and forth with the company's legal team. And so since we're later stage investors, most of the companies we're investing in have raised a round before. And so often we'll try to leverage a company's prior term sheet to try not to reinvent the wheel and make things go a little bit more streamlined through the negotiation process. But things we kind of think about, and we do try to be light, and I think this is changing overall in the industry. Just more founder-friendly terms are kind of becoming the norm, but we are active investors. So for the most part, we require things like a board seat and prioritize terms around our ability to continue to invest over time, because this is something that we think is super valuable.
Awesome. Mercedes, how about you?
And sorry, in terms of the types of terms that are most helpful?
Yeah, types of terms and process, like from the founder standpoint, what can they expect when they are going into negotiations?
I think so. If we're post term sheet, or let's say we're at the term sheet in terms of what type of terms, there's all the typical stuff that Alexandra mentioned in terms of there's the round size, there's the valuation, there's the board seat. There's, typically like we have really standard terms. And so there's not going to be a lot of other things to negotiate. Sometimes there's, founder vesting if there's been an interesting or strange cap table along the way. Sometimes there might be, the option pool, what size should it be? There's a couple of other things like that, but in terms of like liquidity, preference, pro-rata rights, like those are all typically pretty standard. I'd say that sometimes there's also nuances about like what class of shares that you're, which investors have certain rights in terms of major investors versus minor investors. But for the most part, like what at the term sheet, it's pretty straightforward. And then later on, once we're going through financing and docs, there's always little things that come up here and there, but those are super situational to each company. And so, there it might be things like understanding, we'll have things about like different entities that own each other and what's the, rights that the investor has for these different ones that fit together. It gets very legalistic towards the end in terms of the specifics. But that's most of the kind of stuff we see.
Awesome. So what are some red flags that founders should look out for in term sheets when they are negotiating with a VC firm, Mercedes?
I'd say one is to look out for super pro rata rights. It's not always a red flag, but it is kind of irregular in terms of basically allowing the investor to have a guarantee to buy up in the next round. I see that happen sometimes only when the founder offers it because they were not able to get an investor to the ownership threshold they wanted. And so to still make sure that they can get them in the round, maybe they offer it for the next round. But generally, you don't want to see a ton of those all over the places. It should be very rare and few and far between. So I think that's one that comes to mind. Another one's like if the investor is doing too many special kind of rights just for them versus all of the rest of the investors, it can make it difficult for, future financings, or even the existing investors that are already there might get upset in terms of that. So you have to see, like, are they grouping investors together? Are they trying to, call themselves out and have themselves be special? And so that's where there's some of that nuance.
Awesome. And just for the new investors in the room, I'm sorry, we didn't actually go over this in the terms yet, but can you just tell us what pro-rata rights are?
Basically, the idea of every subsequent financing, there's new money that comes in, and so your ownership percentage is diluted, and pro rata rights is a way to buy up in future rounds. You have the right to buy up more percentage. Well, not buy up above your percentage, but you have rights to kind of buy up within each round. And so those get squeezed a lot of times, to be honest, in terms of when other investors come in. Sometimes the founders will have to ask the company to, the previous investors to not do their pro rata rights. So it is a right every investor wants, but sometimes it doesn't always, you don't get the full amount.
Awesome. Thanks. And Alexandra, what about you? Are there any red flags of what founders should look out for when they're looking at term sheets?
Yeah, I think the main thing is, as a founder, you don't want to give out disproportionate control, like just based on the round. So like, think about how many board seats this VC is requesting, like what kind of preference, like if it makes sense. And so I think you agree with Mercedes, you should definitely be careful about things like pro rata rights. Like a super pro rata isn't necessarily a red flag, because it can signal a ton of excitement from the investor. But it's something just worth thinking through, because it could hinder future fundraising efforts. Liquidation preference, I think, also is something that you're seeing less of, like, aggressive terms on those these days, but it's definitely something to have a look out for. And I think some bigger red flags are probably things like guaranteed exit horizons or undiscussed changes in management, things that are really aggressive in that sense.
Awesome. So as founders are looking into term sheets and are negotiating with VCs, are there any best practices you can give both to investors and or to founders in the process, or in what they should look for or hope to seek by the end of the closing of the term sheet? Alexandra, let's start with you.
Yeah, I think for both parties, it's just important to come into the conversation like knowing what's worth negotiating for, and then what you'd be willing to concede on. And then, I mean, I can best speak to this from the side of an investor, but it's really important to spend time understanding what is most important to the other party. And it's usually, like in my experience, it's been an honest conversation. Like, is it valuation? Is it post-close ownership? Is it some level of liquidity or incentive plan going forward? Like, I think things can be very streamlined if you just take some time to understand, like, what is the most important to the other party.
Awesome. Mercedes, any best practices?
I think it's important to just make sure, because there's a lot of different things that can come up, make sure that you have a lot of trust between the parties in terms of, making sure to put in the time of, like, if something bad happens while you're going through, diligence or financing, make sure you update each other right away. You don't want people to find out about things through the lawyers and find out in, documents. And so just making sure that you're being really upfront on both sides about kind of where things are at. I think that oftentimes, like, the process, you want to have a quick close, but sometimes the close process can really drag out. Like, ideally, everyone would have it happen in 30 days, but I've seen it where it goes to 60 days to 3 months. And I think that really extended time frame is something that has to be managed really well by reinforcing, like, we do want to work together.
Awesome. Well, thank you so much. We're going to move to some questions from the audience. So the first question I have for you all, and apologies, Cheryl's sending me these separately so I can see them easily. So I'm not sure who sent the question, but the first question is, do you think it matters how many entities are on a cap table when you're going from a seed round to a priced A round? How often do you have to clean up a cap table, and what types of issues might you find? Mercedes, let's start with you.
I think that, it's one of the questions I have in terms of how many entities are on the cap table. Oftentimes, if it's been a lot of convertible notes or safe notes that are converting into the first priced round, sometimes there can be a surprise to the founder by just how dilutive those notes were. And so I think of it as, we want to make sure you always want to like know what's coming. And I think that having less is just typically cleaner. Like if it's a long laundry list of like 100 or something, the issue is not so much in just putting the cap table together. I mean, that's relatively straightforward. It starts to be in more the management of all the different players on the cap table in terms of this person. Like, sometimes folks asked for different things, like somebody might think that they have pro-rata rights when they may not, information rights, and just having to manage and update all of those people, getting all the signatures for, for all of this stuff. It just can take a lot of time and delay closing. So to me, that's kind of some of the issue. But I think that in terms of like how often does it come up that I have to see a really messy cap table and have to clean up? Not that often. A lot of times I think the founders are keeping the cap tables cleaner and cleaner. So it's like 1 out of every 10 deals has maybe like a not very messy, but slightly messy cap table.
Awesome. Alexandra, any thoughts on cap table cleanup and how many entities there should be and how to manage that?
Yeah, it's interesting. I actually think we see this probably more frequently at our stage. And it's funny, I'm actually going through this process right now. I think one of the things we think about when like the cap table cleanup is on the table is, and this typically happens with companies that maybe like their seed stage was really drawn out because there was a lot of tech development or something like that. And so there's a lot of kind of legacy investors that don't have that same like appetite or enthusiasm to stay on with the company. And so that can just be kind of, it's a little bit like dead weight. I think it's important for the company to think about, you want your investors to be like have a huge appetite for the journey forward. If an investor's been in for 4 years, that's not always the case. And you want to just optimize your cap table for who's going to be helpful or like the most helpful. And so I think that's just the thing. And there's not necessarily like a magic number and like how many investors there should be, but it is like, how do you want it to be as streamlined as possible so that you can really feel like your investors are your partners and you can take them forward.
Awesome. Great. Next question I have from the audience is from Chris. What is the biggest game changer or value add an investor can have on a company at the early stage, like seed or Series A? And Alexandra, you can start first.
Sure. I think I'll have to answer this as, I think Insight has one of probably we're most focused on like how we can be value add. So I think just a few of the things that our companies typically ask for, especially at the earlier stages, is like, how do I think about taking my product to market? And so we're often helping like right off the bat after investment with like hiring leadership, often in like sales and marketing orgs, just kind of restructuring your management team to really not like hiring anyone, but like just helping build up, better management, better parties around the table. And then things like we look back across our portfolio and like track to, okay, how did this company solve this problem? We have a bunch of parties at the table just with kind of these functional areas. And so we'll kind of give best practices to the companies in terms of, how to scale their team, how to think about pricing their products, how to think about kind of these various levers to pull to continue to scale and actually deploy the capital. And I really think like earlier stage is just hands-on experience and just being there to give advice, because there's a ton of hurdles that come into play when you're from the Series A stage. It's a really big jump. And so I think just like constant support, like, can you be there? Can you call your investor is really important.
Excellent. Okay, next question. So Alexandra, this one's for you. As an HR recruiter, how focused, do you bring to the team? How focused, I'm not sure I understand this question. How do you support, hold on. I'm going to go on to this question for Mercedes and I'll come back to that one because I have to read that first before I understand it. So Mercedes, you talked about the analogy of being a salesperson for your, as an investor. As an ex-sales manager, I was always looking to optimize each stage. How do you optimize each stage of your flow? For example, how do you optimize your deal sourcing so that you are seeing more qualified leads for you to evaluate, for you to move to stage 2 of evaluating?
Yeah, I think that's a really, important thing to think about. One thing is just that time will improve the quality of your funnel in terms of there's a lot of emails. For me, there's actually way, way, way more inbound than I can manage. And so it's a part of just picking like which companies to take a meeting with. And so over time, your filter of what you want to see in the email or the initial pitch deck that they send you begins to get higher and higher. And so you start to kind of, take their first meetings. The quality of the first meeting tends to just be higher because you now have a better sense for what great looks like, and you didn't know what was possible. There's kind of this joke in venture that, your first month in venture, 1 in 10 deals look good. Your first few months in venture, 1 in 100 deals looks good, and after you've been there for a year, 1 in 1,000 deals looks good. And so really it's that filtration system. I mean, I think in addition to that, there are other things you can do to make sure that inbound quality is higher. And I actually do a ton of outbound in terms of companies that I find interesting. I send them cold emails. I send several cold emails a day. But in terms of, I think about who are the seed investors, the pre-seed investors who are really good and who I found over time have a good, who have great quality and that they consistently send me great deals. So I'll try and spend more time with them and make sure I'm top of mind for them to send deals on to.
Awesome. Thank you. Okay, Alexandra, I figured out this question. So how much focus do you bring to the team on your deal sourcing and review? How do you support them from a team perspective? And what are some major problems that you find they all seem to have from a team perspective?
Got it. Okay. Yeah, I think Insight has a very strong outbound model. So especially my first 2 years with the team, I did a lot of sourcing. So I was doing, and that's kind of a combination of cold emailing, cold calling, like going to events and finding interesting companies, like presenting and at their booths and things like that. So I still do a good amount of that. I think most of my job now is more on like the triaging of a lot of the this kind of like funnel of deals that we're exposed to through this outbound model. But I think, and what was the question? I think the biggest challenges in sourcing. Mm-hmm. Yeah, I think this is an Insight specific problem. We have a lot of coverage, and I think and if you just the market generally, I think is moving very, very quickly. And so what I've found the most challenging and actually the most helpful just in my career in general is like really honing in on specific areas that you're super excited about and like just being extremely thesis driven. And so like, let me map out this market, find the 3 companies that serve this need that I think are, the top, and then just go after them and really focus your efforts, because I think you can really there's so many amazing companies out there that you could spend like literally all day emailing and sourcing and trying to get in touch with them. But I think being really focused and your effort is just, it's really important. And it also, for me, it just makes the job more exciting because you have one conversation in one category, and then you have another conversation in that category, and you can actually bring insights from your previous conversations and really build up like a base of knowledge that actually makes the conversations more productive for everyone.
Awesome. Thanks. Okay, well, we have just a couple minutes left. I'm going to ask one more question. There's a lot of great questions in the chat. Sorry we didn't get to them all, but I think this is a Republic relevant question. So what's your impression as an investor when evaluating a company that is participating in crowdfunding?
I'm fine with, I was going to say, I'm fine with it. I mean, it doesn't really make me nervous. I think the only thing is sometimes that I have seen where people who raised crowdfunding, maybe the users of crowdfunding they may not always understand that the company is going to go on to raise another round and whether they get to participate in that upside or not. And so I think you just have to see really clear communication between the founders of the companies and their prior crowdfunding kind of community. And I have seen it where it's not been super clear, and then the company gets sued by somebody who was part of the crowdfunding campaign who said, hey, I thought I was going to be participating in all the future rounds of the growth versus it being. And so that's where I think you have to understand there's lots of different platforms. Republic's a really great one, but with some of also the prior generations, I don't think that was always really clear to the people who are investing. So I just look for super clear communication, and we go through like who has sued you so far.
So yeah, so earlier we were talking about conversion and when that happens, and voting rights as well. So make sure you understand that as an investor. Alexandra, what about you?
Yeah, I actually I haven't been close to any of those issues in my experience, but I have like spoken to founders, and we often get in touch with these founders personally, even for us. And I've talked to them through their crowdfunding campaign and like kept track of them. And we've always seen it as an awesome thing. And so I guess if you can avoid all the issues post that crowdfunding round, and if one is aligned on there's going to be different subsequent rounds, then it's fine. But from our perspective, it is no issue at all, and it's exciting to us.
Awesome. Thank you. Well, thank you so much both for being here. We're at the hour. Quickly before we hang up, do you want to tell us how we can follow you or follow Insight and Lightspeed?
LinkedIn is probably the best for me. I have yet to set up a functional Twitter, which is I'm probably the last person in the VC world. So.
Mercedes,
and I please, for me, Twitter or email is best. LinkedIn is a black hole, so don't message me on LinkedIn. So start a little bit of the opposite of Alexandra.
Awesome. I'm the same way. LinkedIn, I just cannot process, but Twitter, email, those are all great ways to get in touch. Thank you all so much for being here. Thank you, Mercedes and Alexandra. For our attendees, thank you so much for coming. Yes, these recordings will be available following the end of this series. You can follow Republic at Join Republic across all social media, LinkedIn, Twitter, Facebook, Instagram. You can follow me at Heather Buffo on Twitter. And thank you again for coming, and we'll see you soon. Join us next week for our last session of the series. And thank you again for coming.